Welcome everyone to today's webinar, State of the Home Health M&A Marketplace. I'm Home Healthcare News Senior Editor Andrew Donlan. Before we get going, I want to go over a few housekeeping items. You will see a variety of boxes on your screen. Those can be moved and resized to meet your preferences, and any resources can be found in the resource box. We will be accepting Q&A throughout the webinar, so if you do have any questions throughout, please do submit those in the Q&A box. This webinar will be available online on the Home Healthcare News website. If you run into any technical issues during the webinar, first, try refreshing your browser. If that doesn't solve the problem, reach out through the Q&A box. Thank you to Mertz Taggart for sponsoring today's webinar. And now for our speakers. Firstly, we have Cory Mertz, who's the Managing Director at Mertz Taggart. We also have Les Levinson, who's a partner and co-chair of the Transactional Health Law Group at Robinson+Cole. And finally, we have David Jackson, who's the CEO of Choice Health at Home. Gentlemen, thank you so much for joining me today.
Glad to be here.
Thanks, Andrew.
Thank you, Andrew.
All right, well, let's get right into it. Again, for the audience, if you do have questions throughout, feel free to submit those. Otherwise, we're just going to start diving right in. So firstly, Cory, I want to start with you. Obviously, most people are probably vaguely aware of what M&A has looked like in home health, home care, and hospice over the last few years, but want to get a little bit more specific. What trends are we seeing right now in the M&A space through this part of the year? What kind of activity has there been?
Yeah, sure. It's short answer, I think, is in terms of transaction activity, deal volume is still low, at least relative to the last 5 years or so. We're in the kind of in the tail end of almost a 5-year cycle, and started with COVID, and Fed stimulated the economy. Interest rates went to federal fund rates went to about zero. Sellers were burned out. They wanted to get out early before the election, and then a new administration increased the capital gains tax rate. And so it was really a perfect storm of activity, and it was quite frankly a bubble in 21, 22. We're feeling the effects of that now. Inflation, went through the roof. Fed has raised fund rates at a pretty healthy clip. Starting in 2022, that really slowed everything down for a couple of years. But now we're starting to see signs of life, although it hasn't panned out or played out in the transactions per se. And by the way, we do a quarterly report on all the transactions that we pick up on. It's on our website. If you don't subscribe to it and you're interested, feel free to email me or just contact us through our website, and we'll get you on our distribution. But transaction volume, we're going to find out here in Q3, still pretty slow, at least relative to historic, but there's more activity going on behind the scenes. I think there's more activity going on now than there probably has been over the last couple of years. I don't know if David or Les are seeing the same thing. So I would expect, well, I don't want to get ahead of myself, but things are starting to pick up.
Yeah, that was good. Go ahead, Les.
I was going to say, I was just going to piggyback on that. I do agree that 21 and 22 were a little bit of a bubble. There was a lot of pent-up demand and a lot of capital to be deployed, and an incredible number of transactions that were executed in that period. I think what we've seen is that the interest rate environment has probably been the predominant driver of clamping down deal activity in terms of volume, and we're going to talk about that a lot during this hour. That being said, we've had a reasonably busy year. We've done some notable transactions, some of which have been publicly reported. So I think that there's been an interest in more strategic types of transactions, and certainly buyers, looking at assets that they viewed as important geographically or strategically, and those transactions have continued to go on. Also, I think the mid-market has been a little bit more insulated than other parts of the market. There's supposed to be a Fed meeting today, and I think if the Fed does what everybody expects it's going to do, we're going to see a real uplift, I think, in the market. Now, whether they get a quarter point cut or a half point cut, I guess we'll find out in a little while after the Fed meeting is over, and we'll talk about that some more. But definitely, there's a feeling of more activity, more inquiry between parties, and certainly in the number of transactions that we've been engaged on in the last couple of weeks has gone up.
David, anything to add there?
Yeah, just, incredibly high volume in 21 and 22, similar to the rest of the broader market, not just healthcare and the home healthcare space specifically. And whenever there's that much volume, there is an integration time period if you're going to do it right. So I think that coupled with, you see this rash of like significant M&A, like more than, and Cory attested to this, like just so much volume. And then you've got to put those businesses together. And I think during that time period, as you start like some of the serial buyers, you start to have that time period, and then you have a straight reduction or increases that slow the broader market.
Yeah, and also we should mention that in 2020 there was COVID, which meant that there was this rush of investors looking to get into the space before all the assets dried up.
Yeah. Yeah, no, that was certainly one of the catalysts. I mentioned a few, but you're right. These investors, especially the sponsors, private equity, they're always looking for opportunities to invest in, and especially the healthcare investors at that time. For a period of time, there were a lot of healthcare deals that were not investable because we didn't know what the path out of COVID was going to look like, or how long that might be.
Okay,
they directed a lot of those funds towards the home because that was still an investable option.
Sorry, just one more test. Am I echoing everyone? Or am I good?
You're good now.
Okay, great. David and I, for a second, we were echoing, and I was getting concerned. But Cory, thank you for picking up there. And then, David, I'm actually going to go back to you. So Choice Health at Home has grown pretty significantly through M&A over the last few years. How do you grow responsibly through acquisition? And if you wouldn't mind giving a little context to the listeners on how many deals you've done, that'd be great as well.
Yeah. So, over the last 4 years, we've done 20 transactions. In my career in post-acute, I've been a part of 48 transactions. So I've been, heavily involved in like pretty much every post-acute sector from a transaction perspective. I think really, at its core, you have to look at really, I say that the first tier is the 2 C's, which is like compliance and culture, and how your business is going to map to the culture of the business you're acquiring. And then also how compliant the businesses that you're acquiring. And, we'll talk a little bit in this presentation or webinar about how you prepare, and compliance is like it's a deal killer, and I think like, especially whenever M&A is at a lower level, just because of the economic environment, it's one of those things that we take a lot more time to transact. We're going to turn over every rock, that's going to create an opportunity for the compliant seller. And then secondly, you just want to have discipline around your goals. At Choice, we want to build a Southwestern business. So we will look at businesses that are complementary. We want to be in the 3 primary silos: home health, hospice, and home care. We want to be in the Southwest, and we want it to fit one of those profiles. So I think sometimes if you're looking at how do you manage a business, you need to take consideration of your corporate, your management team and their capabilities. And if you stretch them too far and you're not disciplined in your strategy, you can create what I call a pile up instead of a roll up. And we want the businesses to be culturally similar to ours. And that's what we found in the Southwest geography is, taking care of some really hardworking people, some people that are precious to me and the rest of our management team is for how we look at care. And those are the types of organizations that we want to acquire.
I love that, the way you put that, David, pile up as opposed to roll up. Cory, is that something that you've seen historically from some providers that are trying to grow quickly, where there becomes a pile up and it's not a efficient roll up strategy?
Yeah, we have seen it. We've seen it a few times over the years. And, I've been doing M&A work, home care M&A work since 2007. So I can recall probably, a half a dozen or more consolidators who probably just got out over their skis a little bit, grew a little bit too aggressively through acquisition. These guys, the ones that come to mind, they were always the group that if you took a company to market, you knew they were going to be the buyer. And because you knew they were going to, if they wanted the deal, they were going to get it. They were going to pay more than anybody. And we don't have that right now, by the way, but those buyers do come and go, and they kind of share the same characteristics, I think. So we have seen it. And some of them, like I said, have gotten out over their skis and have run into some trouble. They'll stop doing deals and focus on integration and turning operations around, with the hopes of eventually, getting an exit. But it can delay things or certainly not create the exit that they're looking for.
Yeah, I think just to add to that, again, going back to 21 and 22, there was so much undeployed capital and almost a stampede to try to get transactions done before the end of the year, and then some of those rolled over into 22. And whether it was welcomed or not, the rapid uptick in the interest rate environment just imposed a level of discipline in terms of doing transactions, and also getting folks to take a look at what they had acquired and trying to integrate them as efficiently as possible. So, you guys have been in the space a long time, and things tend to go in cycles, and whether it's every 5 years or every 7 years, because of external, conditions or otherwise. So, these patterns do tend to repeat themselves.
So, David, do you find that there's an advantage to growing during an M&A downturn? Do you feel like you have a competitive edge there in terms of how many buyers are out there? And also because, payments, it's a turbulent payment period between both fee-for-service, traditional Medicare, and Medicare Advantage. There's likely, more seller interest, I would believe. So do you find there's an advantage to growing during this period as opposed to another one?
Yeah, I think so. First, on payer clarity, as we come into the end of the year, we've got some clarity on final rulings. We kind of understand. And for the larger buyer, that creates clarity in what we're going to try to execute on. If we see, I would love for the federal government to kind of clarify, if they see from their perspective an overpayment in the past, and that's been hanging over our industry for some time. And I believe Luke James over at Vital Caring, he echoes what I say. It's hey, I would love for you guys just to get this off the table so we can get clarity to it and know what we're dealing with. And then I think for the seller, for someone who's exiting the business, we have, so many individuals who've contributed so much to the industry that are 55 and up. And, you start to, the challenges of MA, they continue to look, even though home health saves millions and millions of dollars, to the tune of billions over, 5 and 10 year periods to the broader healthcare system. We continue to see cuts, and I think that's challenging for any operator. And I've been a sole proprietor operator, continue to be so. That is challenging, and it can sometimes say, I want to get out of this. And so, if you're a contrarian investor or value investor, I think it's a good opportunity to be a buyer. Because there's fewer people that are saying, hey, we want to do that. If you've created an acumen like at Choice, we've been very successful in both traditional Medicare and the MA plans. So we have that skill set. And we can look at, a seller in a market that may have larger MA penetration and say, hey, that's an asset we would really like to continue your legacy. And I think about choice in, 2, 7, 15-year period markers and like what we want to do. And I absolutely believe, it's enabled us, 4 of the transactions that we've done in what would be called the down cycle have been some that have made me the happiest as a CEO. Just great cultural mapping, like excellent compliance, and been great assets that we've incorporated into the broader footprint at Choice. So I absolutely think it's an opportunity. And then I also think as a seller, if you're a seller contemplating things, when they start to lower interest rates, that stock market will take off. If you're thinking like, hey, I'm not going to get the multiple that my buddy got in 21 or 22, if you're exiting the industry and you take that capital and deploy it in the broader market, you've decreased your risk at an exit age, 55, 60, 65, you're trying to retire, you've decreased your risk and just diversify your asset. And that's where sometimes I think people, an entrepreneurial endeavor like home health, you have the opportunity to take that cash and move it somewhere else. So when the market is down, you may not get the same multiple, but your cash in a 5-year period is probably going to be in a very similar position to someone who exited at a higher multiple.
Love that point, David. And actually, the MA point specifically is a great segue to a question we've gotten in the Q&A box here. Just a reminder to the audience that joined late, if you do have questions throughout, feel free to submit those in the Q&A box. Cory and Les, how do you believe Medicare Advantage reimbursement and CMS cuts are impacting the M&A market now, and how will they affect them in the future? I think something some of us are guilty of, particularly me, is looking at these things as a major contribution to M&A, where really, as Les, you said earlier, a lot of it has been just the interest rate. But how do you think those factors, and particularly Medicare Advantage reimbursement, because that's something that's going to continue, cuts may eventually taper off. How does that affect the M&A landscape in home health?
I'll jump on that one, Cory, and certainly, are interested in your views. I think for folks who have been in the space, particularly on the buy side, they've come to recognize that every June, the proposed rule comes out from CMS, and then it goes through a comment period and then ultimately gets finalized. And that does add some degree of uncertainty. Certainly in the last couple of years, the proposed cuts haven't been realized. They've been more modest than what's been proposed, or there's been a net positive gain to that. But it adds a degree of uncertainty, and sometimes that either pushes transactions out or causes some buyers to not want to participate. I think folks who have been in the space for a long time, and maybe David, you can even comment on this too, you sort of get used to it. It's part of the landscape, and you've got to take that data point in and manage it. And I think there's some degree of that too in the MA world, where there's certainly beginning to be more focus on the dollars that are going out to Medicare Advantage plans, and is that money really being deployed in the most rational way. So it's an important consideration, but it isn't the only consideration.
Yeah, I would agree. Go ahead, Cory.
I'm sorry. Yeah, I agree with Les. If you look at it kind of historically, right, these issues, CMS reimbursement pressure and Medicare Advantage, these are not new issues. These have been ongoing pressures now for 10, 15 years. Medicare or CMS has been pressuring home health at least since 2014. Been pretty consistent cuts year after year after year. So you learn to kind of work with that. Medicare Advantage is that's a tricky one. I think it generally speaking, not a super attractive payer. If you're taking a company to market, or if you're taking your company to market, one of the first things buyers will typically ask is what percentage of their business is episodic, and when I say episodic, it could be traditional Medicare or Medicare Advantage episodic. That's a key, I think. And then, fee for service. And for most buyers, a lot of fee for service Medicare Advantage is not looked at as super favorable because you can't typically make any money at it. But there are some buyers like David, I think, that see that as an opportunity, right? Because if you have a contract with Humana that these guys don't have, and you can, pick up those patients on an episodic basis, that can be a very favorable thing. Sorry, David, go ahead.
Oh no, I just would agree with that. I think we talk a lot about matching the market. Yeah. So, for those of you guys that are out there that don't know, CMS reports every month the MA penetration, which is slowed. So I think that's actually a tailwind. We started to see a slowing, and there's so much out there right now about the value of what we bring to the table. And so we look at it as if you far outperform the market in episodic payers, is that sustainable? If your market is 50-50 and you're 70% Medicare, 30% MA, how does that continue over time, just given the general population is going to continue to grow? And referral sources are going to expect you to eventually match the market. So we look at you should match the market that you're in to slightly exceed. If you're 5% better, you should be if you have good quality scores. And that's one way that we assess the target is hey, what does your mix look like compared to the rest of, say, the Denver Major Metro or Santa Fe or Albuquerque? How do you look in comparison? And then really to Cory's point is have you been effective pushing dollars to the bottom line so that you're a sustainable program in that market? And that's what we talk a lot about sustainability. We don't want to see crazy, super high profit margins. That's not what we're looking for. We want a sustainable program so that we can take care of people for the next 15 years.
If you're 90% reliant on fee-for-service traditional Medicare revenue, you might have higher profit margins right now, but that could also spell trouble for the next decade when referral sources are saying, hey, you have to take some of these MA members off our hands.
Yeah. You've seen some recent companies that have gone public, some spinoffs that have tried to increase their MA mix to match their markets, and then it is a difficult task. And so being able to perform in your market at the market penetration rate is important.
Another quick audience question that is now on the home care front, home and community-based services specifically in Medicaid. The Medicaid access rule was finalized. The 80-20 provision, which is something we've talked about a lot, is set to be implemented 6 years from now. Is that going to affect the market, in your opinion, Cory? It's far out, right? We don't know if it's going to be implemented exactly how it was finalized. So how does that get taken into consideration?
Yeah, I think most look, it's 80-20 is not a great final rule, but in reality, it seems to be far from final, right? We've got several years before this gets impacted, potentially a change in administration, which could probably change things, and lots of time for this final rule to evolve. So I guess I'm an optimist, maybe a little bit bullish, but the reality is what I'm hearing from most buyers that have been doing home and community-based services transactions and are interested in home community-based services deals remain interested. And it really hasn't, depends on the state and every state's different, but from the values haven't, we're not seeing that turning out in the valuations, I guess I would say. Values have not come down much at all.
I would definitely concur with that. 6 years is a long time. And I think, buyers are thinking about it, but it hasn't been a primary determinant. And I think it's a little less so depending on who the potential buyer is. Some buyers are kind of in a more of a shorter term exit horizon, so to speak, so that they may not be focusing on that point as acutely as maybe someone whose hold period is longer and maybe integrating it into a sort of a broader strategy. And I think, as Cory says, who knows? You could have changes in administration or implementation of this rule, and it could end up being a variety of, of different things. So right now, it doesn't seem to be the bellwether that people thought perhaps it would be.
And I think a lot of cases, it's not in a lot of cases, but in some cases, and some buyers have said this publicly, it's caused them to want to really kind of double down on home community-based services deals and just try to capture as much of the markets that they're in as they can, in anticipation. And this will be an interesting piece. Like how will the the value-based agreements with the MCOs be affected by this 80/20 rule? Because that's what a lot of the larger providers, as I understand, are kind of gunning for. And I don't know, some have more traction with that than others.
Yeah, certainly. And Cory, I think that was smart to mention too, that some providers, Addus has been very public about this. Help at Home is also building scale in markets, because that's what they think will enable them to be successful if this 80/20 provision ultimately does come down. So doubling down, particularly in areas where they already have some scale, but they think they can be successful in the long term. Okay, Cory,
Andrew,
a follow-up.
Also,
go ahead, Les.
Exiting markets where that doesn't meet that thesis. Addus has done that recently in some places too. So I think that just supports what you guys were saying.
Yeah, great
Absolutely.
point. That's yeah.
Okay, and Cory, sort of a follow-up on that, but this can be more than just home care. I think there has been this misconception, again, I'm probably guilty of this at times, that demand is down. But you have told me in the past repeatedly, you probably get sick of telling me, that demand for high-quality agencies is actually not down. Is that still the case?
It is. We see, and if you look back at this 5-year cycle that I'm talking about, right? We had a bubble in 21, 22. Values were not only values at an all-time high, but everything sold for a premium. It didn't matter if it had hair on it or not, because buyers just wanted in, and they wanted to get deals done. Now that the rate environment has changed, the deal environment has changed. These same buyers are still hungry for quality deals, but they just can't. They don't want to, and they're not willing to, and pay a premium for transactions or deals that don't warrant a premium deal. Now, premiums today to premiums in 21, 22, they're down a little bit, but not a whole lot for a quality agency. At least that's my experience.
Yeah, Andrew, if I can piggyback on that too, I don't think demand is down. I think just the execution of transactions for a number of the factors that we've been talking about is what you're seeing, and I think you're getting more of a, I don't want to call it a rationalization, but a kind of a balancing of expectations of multiples versus what the market is prepared to pay, and there are still sellers who are coming and saying, well, geez, I'd like to get what you guys were getting in 2021. Well, that ship's not in port anymore, and we're in a different place, and truly, I believe the interest rate environment has really been more significant than perhaps people have even acknowledging. And when you were doing deals in 21 and 22 at a functionally equivalent to a zero interest rate environment, you needed a lot less equity to do a deal, and the risk in that transaction was being basically covered by debt coverage, and that kind of evaporated as interest rates shot up, and they shot up pretty quickly. And I think that took folks by surprise. So it changed the risk profile of how you're financing a transaction, how you're going to execute it, and it's just taken the market a while to catch up with that. There are still transactions that are being done. You guys are reporting them, and David's executing on them, and Cory's banking them, and we're representing parties in them. So the market isn't stagnant. It's just different. And I think we're going to see, and we're going to talk about a little bit more, as the interest rate environment changes, what does that portend for the balance of the year, and as we roll into to 25. So I'm more of a half full, on that we're going to see an absolute uptick in activity.
And before we get to more specifics on the activity that might be coming, Les, I'm curious what your thoughts are on if you're an agency, let's talk home health, home care, hospice, but if you're getting ready to sell, what do you need to do as an agency to prepare for that? What are the most important things? I'm sure David mentioned some of those earlier, but I'm curious your take, Les.
So maybe a little bit longer of an answer, but I think a couple of things. Start planning and thinking about what you want to do early. And this isn't hopefully a shameless plug for Cory or the legal profession, but you don't really know the market as well as you think you know the market. So don't, in no way should you discount the value of bringing on investment banking support that's going to help you understand who your logical buyers are and where they are and what's the market looking like. Form your deal team, internal and external. Get the appropriate legal support, accounting support, financial support. Figure out who internally you're comfortable with, bringing into the tent early on, and then start to really begin to take a critical look at your agency. If there are problems that are known or knowable, you have a great opportunity to deal with them before you get to market. You can shape the narrative a little bit better rather than having to respond to it in the moment. And I think David would probably echo this as he's representing the buy side. I'm sure that you're highly confident when you go into an agency and the files are buttoned up and you ask a question, you get an answer, the answer makes sense. Even if somebody has to say, I'll come back to you, but when they come back to you soon, the answer is one that is thoughtful. So being really well prepared for a diligence exercise and recognizing that it's pretty unusual for a deal to get done in 30 days. So prepare yourself for something that's going to be a more attenuated process. Maybe you're looking at 3 months, might be 5 months. But if you're proceeding in due course and the steps are following the script, more or less, you're going to end up with a successful transaction. And, we talked about this a little bit before and continue to do so. Compliance is key. Make sure that your compliance house is really in order. And if there are things that you can address before you get to market with the help of your advisors, whether they're Cory or a banker or legal or otherwise, you're just making your transaction much, much more smooth and a higher likelihood of success rather than going down a road and finding out that you may not actually execute.
Yeah, I would just say, we talk a lot at Choice about eating your cereal, like waking up and doing, thinking about how you're going to rock it out that day. And if you're running a business, I help a lot of my friends in sectors in healthcare that are outside of home health, but 100% what Les is saying, engage a professional banker that's going to help you prepare your business. I mean, that is just it's silly. You wouldn't go sell your house without the assistance of a real estate agent, that understands the market, and you're going to look for the best one. And this is your life's work in all likelihood. So this is an entrepreneurial effort. And then also from the core pillars, we're going to roll in as a buyer. And the first thing we're going to do is go compliance. If you cannot pass a compliance audit, you cannot be financed. And that's one of the things that I say a lot about private equity in healthcare is there's this misconception out there. You cannot borrow dollars without ensuring compliance in private equity. That's not the case in every other form of ownership in healthcare outside of the publics and private equity. We have to be audited on a continuous basis. So when you go to sell your business to a buyer, they're going to try to seek a loan. Well, that bank's going to say, let me see the compliance report. So you need to look at your PEPR reports. You need to look at your QAPI. You need to understand things. And to Les's point, the faster you present those items, the more confidence I have as a buyer. I'm like, the seller understands their compliance arm. And then the second thing is financial. If you're not in accrual, how do you run your business? So thinking about being an entrepreneur, this will help you if you're not selling. Be in accrual. Understand how you're doing financially. Because if you're going to go to market and you're just I'm in cash, you're going to be surprised somewhere in the process because you're not making the dollars that you think you're making. You don't understand your business well enough. And most of the time what we find is people who don't understand their business financially also are not very compliant, because it's just like that spreads into the rest of your business. So I tell people, like, if you're not in accrual financially, you're not prepared to go to sell. Just, you're not.
Yeah.
And then I tell people, like, from a compliance perspective, if you don't understand what you're doing from a compliance perspective, and you're not doing consistent audits, you're not prepared to go to sell. And your banker will tell you that.
Yeah,
So we'll get it back.
just sort of jumping on the back of that point there, because we do about 50% buy side, 50% sell side. Having the right team around you, bankers, lawyers, accountants, they're going to appreciate what you as a buyer need and what your expectations are and what's achievable in the transaction. And that will go a long way to having a successful transaction, getting it executed, efficiently and on terms that everybody can live with. So to your point, if you're looking at a financial presentation and you're going to have trouble with it because you can't rationalize it, that's going to be maybe a non-starter for you, unless you look at that asset and say, I love this asset. We're going to figure out a way to to get the financial basis out that we can live with.
Yeah, I'll just add a little bit to what David and Les both said, and I agree with everything that both of them mentioned. It and again sounds self-serving, but my response was going to be, engage with an M&A advisor or banker that can help you with some of this stuff. David, you had mentioned cash to accrual, right? That's one critical piece that, if you don't do that before you go to market, you're either going to be unpleasantly surprised, or you may not be surprised, but you may not have gotten the deal that you were looking for, that you should have gotten. But that's something that a good M&A advisor will do, with you and for you, and model it for you and show you how that's done. And we'll also go through it and share with you, once you kind of do convert everything to accrual, how does the buyer universe look at this agency from a margin structure perspective? Gross margin, overhead, net profit, or adjusted EBITDA. Those, when buyers are looking at financial statements, those are typically the first things they'll look at.
Yeah. All right, and maybe one last thing, because a little bit more broadly, I mean, every buyer is likely to do what's called a Q of E, a quality of earnings analysis of your financial statements, whether they've been recasted or straight. So it's also important that you understand where those adjustments might be proposed and what you might have to accept, or what you're willing to accept, or maybe some adjustments that you might be proposing that may or may not fly, or maybe that you didn't even appreciate were achievable. So that's kind of part of that whole analysis that Cory's talking about, your advisors are going to bring to the table for you.
David, are there certain specific things that you see a lot, like red flags, when you're looking at sellers, things that stick out the most, that maybe even small things that can be easily fixed, that just aren't always tightened up on the seller side?
Yeah, I mean, I think we've kind of touched on them as far as like preparation for it, and I thought Cory and Les, when you think about going to sell your business, like, hey, these are like mow your grass in the front yard type things, like you're just talking about your house. Really, the biggest red flag is when we start going into compliance and they're not prepared for just presenting the basic documentation regarding like how they qualified patients in the COPs. And so I think it's really important, to Les and Cory's point, if you engage a professional that's going to brief you on that and really get you in position to quickly respond, because we, especially, and I'll touch back on this, a quality home health asset, I think, is the premium in post-acute care. Like, hospices have a really nice base. Home cares have really, steady valuations, much more steady than the other. They don't go up and down as much. A premium home health care asset, skilled home health, that is doing well from a compliance, quality, and financial perspective, is more and more rare every day, because it's hard, very difficult industry. And so if you build your organization, you have to think about what your exit goals is. Is it rolling? Is it selling? You want to build your organization. If like I said earlier, if you have really, really high margins, we're going to start looking like, why are they so high? Like that's a red flag. If you don't respond, and you don't understand the compliance part of your organization, big is probably a non-stopper to Les's point. And then really we kind of put financial as like one of the lower rung things as far as like how we look at a skilled asset. And the larger you are, the more compliance is going to be the biggest thing, because larger buyers, we understand what we can do with revenue. We can fix a lot of that. We cannot fix a compliance issue.
Cory, Les, anything to add there?
I think David has really touched on it. I think one other little piece is that as part of your due diligence process, and I'm curious, David, if this is kind of how you approach it when you're doing it, the seller should be able to kind of explain from the beginning of the process to the end, and not necessarily in a high level of detail, but starting with, what are your intake processes? How do you, who's working on that stuff? Who's touching these files? How do you get from here to there to the billing? And if there's an issue in billing, how is that getting, managed on the back end? And I think that would probably give you a fairly streamlined view about, okay, this seller, I think to your point, clearly understands compliance, and I have different verticals in there, and I've got to get them each right to make sure that the whole picture works.
Yeah, I agree. One of the things that we talk a lot about regulations in our industry. I love the RCD, the Review Claim Demonstration. So we're proactively putting documents, and so that has actually made a much more skilled home health a much cleaner investment, because unless representing legal on this call, we can do a lot of things about non-COP or non-qualifiers. Like, if it's not an issue of like face-to-face being present, signed order, things that you would have to, if it's not that type of issue, we can do a lot of education with staff and improve and work on QAPI. And I think RCD is actually, from an intake process perspective, made home health a much better investment, just from a pure investment perspective, and also just ensured compliance. And I think those programs, I think TPE is great because it provides education to the teams and things that they can fix. I'll tell people, hey, tell me about your audits and how you responded. Show me your responses. And to Les's point, I want to see, like, do they understand their response, and did they fix the underlying issues? Because we're going to be audited. But RCD specifically has really improved this industry's investability.
David, I think as you said before, people think maybe, at first blush, how hard can this business be? It's a more complicated business than I think people, sometimes appreciate. And there's lots of nuance to it, and there's a lot of gray. And the fact of the matter is that nobody can be perfect here, and that's not a badge of fault or shame or anything else. But recognizing when there's been a problem, okay, well, how do I address that problem? How do I fix that problem and get to the best outcome that I can get for my agency? And maybe working with a buyer if you're in a transaction, what's the best outcome here? So smart people putting their heads together can usually get to the right outcome.
I agree. That's the Moneyball reference. It's incredibly hard. That's what.
One other note on the compliance side. I think a lot of folks have a false sense of security that because they just aced their most current survey that everything is ready to go, and you're not going to have any issues getting through due diligence. I would recommend anyone that is considering going to market over the next any period of time would be to do a small billing audit. There are groups out there that can do that fairly affordably now. So they'll just pull a sample and kind of go through everything, right? Look at the compliance, make sure the face-to-face is done, everything else for those particular patients, and they'll give you a report and tell you how you would fare, kind of from an error rate perspective. And everybody has errors, by the way. don't think I've ever seen any that had a 0% error rate. It's just what percentage is tolerable, and I think that you have to look at it from a technical error and a compliance perspective as well, right? David, might kind of getting that right?
Absolutely. I think also just like you can have the outside parties, but Palmetto, some of the other intermediaries have some great tools on their website for pre-billing audit. They use them for TPEs and other things. And I think I always urge people, take 30 random claims and run your audit, see how you perform. I mean, that's important. You should be doing that at all times, like from a QAPI perspective.
Okay, another good audience question. Cory, are there any, with uncertainty over the election, are there any scenarios around the FTC and the role of private equity in healthcare that you're especially watching for? Or is that a little bit overplayed? We've also heard recently that, private equity is a little bit less involved in healthcare in general and in home healthcare specifically than I think a lot of people think.
Yeah, you're right. I think the number that pitch book Rebecca Springer came up with was 3%, something like that, of all of healthcare is owned by private equity, which was surprising, but I trust their numbers. Always something that we're concerned about, especially in certain states. It's going to make deals difficult to get, really difficult to get done because private equity, who typically, make up 50 to 60% of the transactions that are out there, are now afraid to go into some of these states. So yeah, we're keeping an eye on it. I think the election may impact, what happens there, but I think generally speaking, the climate and the environment out there is a little bit heavy on the anti-regulatory side.
Yeah, Andrew, I think everybody probably seen in the papers too. Yeah, there's a little bit more tilt to policy from an antitrust perspective. A number of the states have adopted enhanced transaction notice requirements. I think there's 13 or 14 now, and there's a bunch more. Not a surprise, California's probably been the most rigorous of those. And there's a bill that was passed in the California legislature that's awaiting the governor's action on it, which is geared more to private equity than I think almost any other one. But that just portends that, a heightened interest in agencies being subject to a higher regulatory review if they're dealing with a private equity firm. And it isn't just the East Coast states and the West Coast states. There's some in the middle, like Indiana, that have also adopted those. So I think it's just something we have to pay attention to.
Okay, we got about 10 minutes left here. So I got a couple more broad questions. The first being, obviously in home healthcare, this has been something, a major storyline over the last few years has been payers getting more involved in home healthcare. So Humana, United Health Group, et cetera. But those two specifically, do you all think that payers will be looking to consolidate the home health industry in the future more on a continuous basis? Or do you think that's something that will slow down now after those three major transactions, one of which hasn't even been completed yet in Amedisys? Cory, let's start with you here.
Yeah, I'd like to think that it's going to pick up because I think these payers understand the value, especially for home health. But I think it's clear it's going to be more difficult. And you mentioned the Amedisys transaction. That's been pending for a couple of years now, maybe longer. I don't know. 14,
15 months we're at now.
Okay. All right. I'm exaggerating, but it's been a while, and it's still not quite sure if and when that's going to get approved. So because of that, I think maybe a lot of these payers are going to, I don't know, maybe they're going to wait and see unless it's clear that there is no potential, antitrust issue, and I don't know how you can get that kind of clarity.
Right.
Yeah, it's I'm wondering whether that's really part of a more bifurcated market kind of analysis. I think those payers, with deep balance sheets, so far I've been looking at larger acquisitions, and whether they pursue some of the other public companies down the road remains to be seen. But I think we would all agree that the market still continues to be pretty fragmented. So query whether sort of a rolling up strategy by payers in the mid to lower mid market is something that they're going to have the appetite to pursue. So I don't know. I'm curious. We'll have to see.
Yeah, I would just say, they have, obviously right now, MA scrutiny might be one of the most significant touch points in healthcare, and really interesting to watch as you see like people in certain organizations in our industry, pulling away from contracts, publicly saying they're pulling away from the table. I also, contemplate, those MA plans are looking at profitability on a much broader scale outside of just home health. But, if it's not a payer thinking about entry, there's large health systems that think about entry. There's groups like Amazon, Walmart, Dollar General. I mean, there's just this host of people that continue to look at it. And I get excited because I just think there's so much value here. But as far as the payers specifically, to Les's point, I think it's almost like they're evaluating their current business. They're looking at issues with antitrust, and then they're also considering like how much can we glean and learn from it? Because even with the Medicine and LHC, it's a fraction of the total covered beneficiaries. Still highly fragmented market. So how much can they learn from those assets and understand? Because they're going to have to continue to deal with other providers, and hopefully it endears them to our industry.
Okay, fantastic. Finally, I want one prediction from each of you on the future of home care, home health, or hospice M&A. Let's do near-term future. We can do near-term and long-term, but for now, let's do near-term. One thing that you're expecting out of the market coming up here, Cory.
Yeah, near term being, let's just call it the next 6 to 12 months. I think
Yep.
we will see. I think we've hit bottom in terms of transaction activity. I think we're going to see an increase in activity. I'm not going to go quarter by quarter because that's a little bit too granular to try to predict. But over the next I would imagine over the next 2 to 4 quarters, we'll see a substantial pickup in transaction activity. It's like I said before, it's starting to happen now in some cases. It's not extreme, but I think the consensus is activity is picking up. And as Les mentioned, there's pretty strong anticipation that the Fed will start cutting rates tomorrow, I believe, is when they announce. It's just a matter of quarter point or half point, and I think that will continue. Although that's already been kind of built into the debt markets, that will continue to excite some folks, I think.
Yeah, I mean, I would agree with that 100%. I think if that cut comes tomorrow, Cory, we're kind of all expecting. I mean, if it doesn't, the year is going to come out of that balloon big time. But I think it's also going to inspire confidence that we're moving from an upward trend on interest rates to more of a downward, trend, and I think a little bit more predictability. So we definitely, I mean, we are seeing in the number of new engagements that there's already an uptick in that. I think you're right that the broader market has already baked that in. I don't know what the market's closing at now, but yesterday it was 41,000, plus at the Dow. So that's there. So yeah, in that 6 to 12 month period, it definitely feels like it's going to be vigorous. And home care, hospice have been important pillars of the healthcare system, and they're not going away. And they're going to continue to play an important role in that. So I continue to be positive even in the longer term.
Yeah, I would just say in the near term, we've got payer clarity. We've got interest rates that you could forecast. And if not tomorrow or today and tomorrow, like how are they they're going to go down. So you've got interest rates going down. You've got payer clarity. You've got several funds that are at the end. If you think about buying in 2021 and 22, you've got a lot of funds that are at exit periods around 5 years. So they're going to be exiting assets. And you've got funds that have been holding funds to deploy and have been waiting for the right assets to exit. So like in the near term, I could see 25 and early 26 just being a really opportunistic time from an exit and from a buying perspective. In the longer term, I love this industry, and I just think like we forget that the largest group of beneficiaries to ever move into this market is still just entering the market. And I think from an investment perspective, we had the perfect storm in long-term care facilities. If you look at KKR's reporting and CMS reporting, occupancy rates have steadily been clicking up since the pandemic in long-term care. And you couldn't build during the pandemic because you could not finance long-term care facilities during the pandemic. It was almost impossible. And then interest rates became prohibitive in long-term care facilities. So where are those patients going to go in the long term? We've had 6 years of not building, and the largest group of beneficiaries are coming down on us like a tsunami, like they always said. So long term, very bullish on the industry, and excited to get the opportunity to take care of the greatest generation.
All right, fantastic. I think that's a perfect place to leave it. Cory, Les, and David, thank you so much for that robust discussion. I think our audience really appreciated it. Audience, thank you so much for tuning in, whether it was live or you're watching this on demand. And then finally, thank you so much for sponsoring the webinar, Mertz Taggart, and bringing this all together. Thanks, guys.
Thank you.
Thank you, guys.
Have a good one.